how big of an impact, sir. Thanks so much for that. Let's figure out how big of an impact could this be. K. Suresh, President of Association of National Exchanges Members of India, and Dhiraj Relli, Managing Director and CEO of HDFC Securities, join us right now on the show. Gentlemen, thanks so much for joining in. Dhiraj, just want to understand what is your sense, because I think different brokerage houses have also given it a slightly different color of the overall impact, but key being banks get a play and brokers and other intermediaries now have heightened competition and probably going to lose out.
See, there is no significant impact on the client-based brokers. The impact is only brokers who are largely transacting in the prop book only. So client-based brokers who are listed, unlisted, hardly any impact on them. This was the practice where they have to give the 50% kind of a margin for bank guarantees, and out of that 25% in the cash. So that's absolutely remaining the same. The impact is on the prop brokers. Now they have to give 50% cash and 50% in cash and cash equivalent, which means that they will have, there are issues, their impact cost will increase, their borrowing cost will increase, and this will impact the liquidity, impact cost and spreads in the F&O space. So 40% of the F&O volume is done by the prop brokers. That's where there are concerns. So we expect that overall market F&O volume should come down close to 15 to 20% effective 1st April. And it's a culmination of STT increase and now this RBI circular and also the earlier measures taken by the SEBI. But there are some plus of this circular also. Now banks can actually lend for the MTF purposes also. In fact, it clarifies what are collaterals that can be accepted and what are the haircuts that will be applicable. These were not clear. So the circular is providing only transparency and clarity. There are no significant impact on the client-based brokers.
Just a couple of points on that point, and good morning to you, Alex here. The assumption is in a certain number of pockets that this will lead to a certain extent to consolidation in this space. The relatively smaller players will be unable to operate at scale. Is that the right interpretation?
I don't think so. It will lead to any kind of consolidation because those brokers who are essentially trading in the prop book, they are trading in their own money only, they are transacting in their own money only, and they are not accepting client funds and they are not trading on behalf of clients. So there, I don't think so. They will migrate in any case, or the client-based brokers who would be interested in taking over some of these prop brokers. Client-based brokers also have a choice to do the prop book of their own, and some of them have been doing also. To that extent, some of them will get impacted, but most of the client-facing brokers have very limited prop book, and hence the impact will be very limited on them.
K. Suresh also with us this morning. He's present.
Both of you gentlemen have spoken about this equity collateral 40% haircut, and that seems to be a sticking point beyond what the implications are for prop traders. Last word from you, Dhiraj, on this particular point. Is this the most painful point in your opinion?
No, there was no clarity on the haircut. So what essentially this circular does is to provide clarity what you can take as collateral and what haircut you can take. Earlier also banks were taking the haircut only. Nobody provides loan against shares 100%. So in any case for a retail customers up to 1 crore now, they take haircut of 50%. Most of the NBFCs who lend it to promoters also do the haircut of at least 40%. So I don't think so. This is a big bone of contention. The thing is that earlier the clarity and transparency was not there. Now there is a clarity that what it entails for the client-based brokers, what it means to the prop brokers, and now there are some more funding options are also getting opened. Let's say you can non-MTF trade receivables. Client owes you money, you can borrow against that also. Earlier banks were not lending for the margin trade facility. Now banks can lend for margin trade facility also. also with some terms and conditions. Earlier, all brokers were approaching only market participants and going through the CP routes only. So that's over 1 lakh crore market for the banks to get open. Of course, it will take some time. They'll also go through the details and come out with a offering on MTF side.
Sure.
So my take is that it is bringing a lot more clarity. One more thing.
Do you think there'll be a 30% drop in volumes, as K. Suresh is saying?
I have already said, Tamanna, my take is that it will impact 15 to 20% of the FNO only. It's not just because of the RBI intervention or RBI circular. It's culmination of RBI action, STT increase, and earlier steps taken by the SEBI.
Sure. And the one point you wanted to make, Dhiraj.
Yeah, so if in a normal course of business you want to, let's say, take a new office and you provide 100% collateral that as an office, you can borrow as a normal normal borrower. So that will not be counted as a capital market exposure. In any case, banks are not short on the capital market exposure. So to that extent, I don't see any significant impact on the capital market exposure of the banks.
Okay, thank you so much, Dhiraj Relli there, K. Suresh, both giving perspective on the new norms that Reserve Bank of India will have. The direction is very clear to not encourage, or I would say rather discourage one certain kind of trading which is coming from all ends. We'll take a very short break. I want to look at the implied open before we get into that break. On the other side, you have Parag Thakkar and Kush Bora coming in with strategies for the day. Stay tuned.